Hello everyone. Welcome back to the new video of AP Knowledge Point. Today's video is about transitional guidelines, technical nuances, and administrative shifts introduced in the Income Tax Act 2025. First, transitional framework and continuity. The transition from the 1961 Act to the 2025 Act is governed by specific savings provisions to ensure stability. General clauses act protection. Rights, benefits, and liabilities that arose under the 1961 Act are protected. If an unforeseen situation is not explicitly covered in the 2025 Act, Section 6 of the General Clauses Act 1897 will apply to maintain acquired rights. Administrative continuity. Existing PAN and TAN, that is, permanent account number and tax deduction and tax collection account number, remain valid. Pending applications for PAN as of 31st March 2026 do not need to refile. Faceless scheme. Existing administrative frameworks, including faceless assessments and faceless appeals, continue without interruption under the Act. Circulars and notifications. All previously issued circulars and instructions remains applicable provided they do not conflict with 2025 Act. Second, advanced corporate computational rules. The 2025 Act introduces stricter or clarified conditions for business deductions. Additional depreciation section 33. The conditions for claiming 20% additional depreciation on new machinery has been tightened. The asset must now be first put to use for business purposes. If an asset is used for any non-business purpose before its business use, the additional depreciation will be denied. Surcharge deductibility section 37. While the 1961 Act was ambitious, the new Act explicitly states that a deduction for surcharge is only allowed in the tax year it is actually paid, regardless of the accounting method. Payment evidence. Taxpayers are no longer required to furnish physical evidence of payment with the return to claim deductions for amount paid before the filing due date, as this information is now captured within the standardized schedules. Third, international and non-resident compliance. Significant changes affect cross-border transactions and non-resident employees. Restrictive salary TDS Section 35C. For salary payments made outside India or to non-residents, the deduction is disallowed if TDS is not paid within the same tax year. This is more restrictive than other TDS provisions, while generally allow payment up to the return filing deadline. Overseas remittance. Now, what is remittance? A money that is sent to somebody in order to pay for something. If a remittance is made after 1st April 2026 for a liability that occurred earlier, the filing forms Form 145 and 146 of the 2025 Act must be used, but the taxability will be determined by the 1961 Act. Lower TDS certificates. Certificates issued under Section 197 of the old Act remain valid after 1st April 2026 if they were issued for projected receivables for tax year 2026-27. Fourth, maintenance of records and audit thresholds. The Act modernizes record keeping and sets clear audit triggers. Cloud storage. The definition of books of account, Section 2 of 19, now explicitly includes records maintained on cloud storage. Audit threshold, Section 204-205. Business. Audit is mandatory if turnover is exceeding INR 1 crore. Digital incentive. The threshold increased to INR 10 crore if cash receipts and payments are each limited to 5% of the total. Profession. Audit is mandatory if gross receipts exceed INR 50 lakh. Presumptive opt-out. Taxpayers who previously used presumptive schemes, Section 44 AD and 44 ADA, but now claims profits lower than the deemed rates must undergo an audit if the total income exceeds the basic exemption limit. Fifth, digital enforcement and investigative powers. The 2025 Act grants the tax department broad powers over virtual environments, virtual digital space. This new definition brings email servers, social media accounts, messaging platforms like WhatsApp, Telegram, and cloud storage, Google Drive, and Dropbox within the legal jurisdiction of search operations. Searchable assets. The definition of assets for CGUN now explicitly includes virtual digital assets such as cryptocurrencies, NFTs, and digital collectibilities. Sixth, specific relief and updated filing. ULIP taxation. If the annual premium for a unit linked insurance plan exceeds INR 2.5 lakh, the returns are now subject to capital gains tax. Updated returns. Taxpayers now have 4 years to file updated returns, providing more flexibility for rectifying errors or making voluntary disclosures. NSS withdrawals. Withdrawals from the National Savings Scheme made on after 29 August 2024 are now tax exempt to encourage long term saving. MAT credit. Unutilized minimum alternate tax, that is MAT credit from the 1961 Act, is grandfathered and can be carried forward under the 2025 Act. Seventh, amalgamation loss carry forward limits. Under the Income Tax Act 2025, the provisions for the carry forward and set off of accumulated losses and unabsorbed depreciation in business reorganizations have been specifically updated. 8-year limitation for amalgamations and other business reorganizations. The carry forward and set off of accumulated losses and unabsorbed depreciation is now limited to 8 financial years. This period is calculated starting from the year the loss was first computed by the original or predecessor entity, rather than restarting from the date of amalgamation. Treatment of violations. If an amalgamation occurred under 1961 Act and the prescribed conditions for the carry forward of those losses are violated after the new act becomes effective, the resulting deemed income will be taxable under the Income Tax Act 2025. Transitional rules. Any loss, set off, or depreciation allowed in earlier years that becomes taxable due to violations of conditions will be treated as the income of the amalgamated company in the year non-compliance occurs. Eighth, APAs, that is Advanced Pricing Agreement. Continuity of existing APS. Any advance pricing agreement entered into under the Income Tax Act 1961 remains valid and continues to apply under the Income Tax Act 2025. This continuity is subject to the condition that the existing agreement is not inconsistent with the specific provisions of the new 2025 Act. Transfer pricing reform. Block period system. While not specific only to APAs, the 2025 Act introduces a significant shift in how international and specified domestic transactions are assessed through a block period system. 3-year computation. Instead of determining the arm's length price every single year, business can now compute it over a 3-year block period for similar transactions. What is the arm length price? To know this, go and watch the video whose link is provided in the description. Objectives. This reform is intended to improve predictability for multinational enterprises, reduce repetitive litigation, and align India's practices with global standards. Strategic impact. These updates are a part of the global goal of the 2025 Act to provide certainty in corporate tax administration. Multinationals and foreign companies are encouraged to review their existing contracts and transfer pricing documentation to ensure they align with the new block period rules and restructured sections of 2025 Act. Now let us see some questions and answers based on it. Question 1. Under the Income Tax Act 2025, how is the deductibility of surcharge on taxes treated in comparison to the previous 1961 framework? The answer is it is explicitly allowed as a deduction only in the tax year it is actually paid, regardless of the accounting method. Question 2. What is the primary legal implication for an individual leaving India to search for job opportunities abroad under the residency rules of the Income Tax Act 2025? The answer is the relief now requires actual employment rather than mere purpose of employment. Question 3. Regarding the 20% additional depreciation on new machinery under Section 33 of the 2025 Act, which scenario would lead to the denial of the claim? The answer is the machinery was used for a non-business purpose before being deployed for business operations. Question 4. How does the Income Tax Act 2025 modify the compliance requirement for salary payments made to non-residents under Section 35? It mandates that TDS must be both deducted and paid within the same tax year to avoid disallowance. Question 5. If an overseas remittance is made on 10th May 2026 for a business liability that occurred in December 2025, which legal framework governs the transactions? The answer is the 2025 Act governs the form filing requirements, while the 1961 Act determines the taxability of the underlying income. Question 6. In the case of corporate amalgamation, what is the specific limitation introduced regarding the carry forward of accumulated losses? The answer is the carry forward is limited to 8 financial years from the year the loss was first computed by the original entity. Question 7. What is the status of Advanced Pricing Agreement APA entered into under the Income Tax Act 1961 once the new Income Tax Act 2025 becomes effective? The answer is it continues to apply as long as it is not inconsistent with the corresponding provisions of Income Tax Act 2025. Now let us recall what we have seen till now. Surcharge deductibility rules, residency rules narrowing, additional depreciation conditions, non-resident salary TDS constraints, cloud storage as books of account, virtual digital space investigations, digital incentive audit threshold, transitional remittance filing, amalgamation loss carry forward limits. Advanced Pricing Agreements APAS. So ending this video here. If you like this video, like it, share it and comment below. Don't forget to subscribe the channel and to get notifications for the new videos, press the bell icon. Comment below from where are you watching this video.